Small caps have led stocks to records. This has been driven largely by performance from regional banks as well as real estate firms. High-yield bonds are also given the stock rally an all clear. I'll explain what I mean. Will we see a 10-year yield below 4% in September as bonds rally? Bonds and the yields are moving in the opposite direction. Dollar is under pressure as euro is breaking out into a new uptrend. British pound is already there. And gold is going for records on dollar weakness. Today's edition of MasterChartsTrading.com for Friday, July 12, 2024. As always, please don't forget to hit the like button, subscribe to this channel, share this video. My name is Alexander. Please visit my blog at MasterChartsTrading.com where you can sign up for my indicators as well as trading newsletter. If you're a subscriber, stay tuned. We'll be covering a very large selection of stocks as well as various securities that are not covered in the general video, namely market breadths. British pound, Bitcoin, Ethereum, copper, crude oil, and natural gas are the bigger ones, as well as ETFs, large cap stocks such as Tesla, for example, as well as some of the speculative securities. You can see there's quite a bit of them. For example, Groupon was a nice trade recently, Ford, as well as IBM, all successful trades, as well as several of the gold-related stocks also are outperforming. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com market price action indicators, which you can see on this chart, this green, blue, red, and yellow lines. You can follow the link in the description to find out more information. So, again, non-stop record highs, pretty much non-stop this week. One little blip was this yesterday, the July 11th, when the large amount of data came out, including the inflation data. And it was really interesting to note on this date that we have the Magnificent 7 ETF, which includes such stocks as Tesla, Apple, Facebook, Meta, Nvidia, Alphabet or Google, Amazon, and Microsoft in about equal proportions. So notice this big drop here on Thursday, 11th of July, yesterday. If we look at small caps, IWM, on that same date, Thursday, 11th of July, not only it gapped up, it continued higher and closed at 2-year highs. These are 2-year highs. This wasn't, yes, 2022, even more, 2.5-year highs. Not yet record highs, but definitely something is telling about this situation where we have a small percentage of large cap stocks moving down on yesterday and Thursday, while a lot of small caps in unison just gapped up and continued higher. The average effect on the general stock market, or rather the S&P 500, was a drop, because this is a market capitalization index. S&P 500 is a market capitalization index. So definitely if you have the 6 or 7 biggest stocks in the United States, or maybe even in the world, all of a sudden dropping significantly, yes, the market capitalization index, S&P 500, will drop. But if we look at an average stock within the S&P 500 on that same date, and to do that we need to look at RSP, equal weight ETF, ticker symbol RSP. So RSP is basically it treats all stocks within the S&P 500 as equals. So Apple would be identical to any of the medium or small cap stocks, about 1% or so. So notice that RSP on average, so this is an average stock, on Thursday actually gained. So that's because of the mid cap and the small cap outperformance on that same day. So by and large, this is good news because this is showing, well, this is as broad as it gets. This is a broad market participation. And notice that the equal weight ETF also has hit an all-time high. This is an all-time high that we have never been here. So in general, I am very pleased with the performance. I really like the fact that not only the Magnificent Seven are leading the stocks higher, but also small and medium cap stocks are also moving higher. So small caps, as I already pointed out, just hit 2-year high. Again, broad participation is good for stock market. Within the small cap universe, we need to look at the outperformance by regional banking. And additionally, before we get to regional banking, let me actually talk about the interest rates, because banks like low interest rates. They can make more money. Their margins are bigger. So notice what's happening to the 10-year Treasury note yield. Back in May of this year, I was saying that we are seeing a break below this blue support resistance line, namely on 15th of May. And that break occurred, it corresponded to about 4.44% interest rate. So we dropped below it. We rallied a little bit up, but then we continued lower. And finally, on that same day, on yesterday, 11th of July, on Thursday, when the inflation data was announced, notice that the interest rates broke below this red support resistance line. This means that we are now officially in a bear market for the Treasury note yield. Okay, if we're in a bear market for Treasury note yield or Treasury yield, that means bonds or Treasury bonds, Treasury notes are actually in an uptrend. So to take this point further, I think that if this continues, and looks like it's gonna continue, looks like we're seeing money moving to bonds now, I think we will continue dropping as far as the interest rate goes, and I think possibly around maybe even mid-August or September, we will see interest rates below 4% on the 10-year Treasury note yield. So good news all around. Stock market is outperforming on broad participation, and interest rates are dropping as well, naturally, without Federal Reserve intervening at all. So here is this same inverted chart, because this is 7 to 10 year Treasury bond ETF, so IEF. And notice that we've been buying this ETF, those upward facing arrows. In fact, I own it myself. I bought it back in February of this year. What's nice about this ETF, IEF, is that it pays dividends monthly. And in this case, I'm already in the plus, not only from the principal appreciation, but also from the dividends, obviously. So overall, I'm pretty happy with this trade. And to hammer in the point is that we're seeing bonds rally while interest rates are dropping. Okay, so interest rates dropping is good news for the stock market. And lower interest rates are specifically very good for several groups, and that is regional banking, real estate, and to a lesser degree utilities, XLU. So this is a regional banking ETF, ticker symbol KRE, and notice it is also breaking out. I just wanted you to realize, appreciate the outperformance here on Thursday. It gapped up and continued higher. So definitely lower interest rates are making regional bank investors very happy, and I think this will continue, especially if the interest rates will continue to drop. The very similar story occurred with real estate, ticker symbol IYR. Okay, same Same general principle. Notice this gap up between 10th and 11th of July. So between Wednesday and Thursday, it gapped up and continued higher. And so again, real estate is actually doing quite well. It just hit about a 1.5 year high. Okay, it's not yet an all-time high, but it's definitely approaching, definitely at 1.5 year highs. This is about 2-year highs, and then all-time highs are not that far away. So real estate seems to be awakening from a slumber. So by and large, the situation with stocks is quite good, I think. We will continue most likely seeing new records. When will this stop? I mean, this is a monster rally. It's not unheard of, but it's definitely a very strong rally. So for now, we're keeping our positions open. I'm open on S&P 500 ETF SPY. I bought it back in October, and I'm still long. I'm still holding my position. 34% gain, very nice. I'm not complaining. I'm still open QQQ, the Nasdaq. This one I bought even earlier. I bought it back in January of 2023, so over a year and a half ago. This thing is up 78%. My position is up 78%, although I did take profits along the way, so it's not a full position. But by and large, you could have also taken a position back in April of last year. That was literally the last opportunity. And how do I know? I'm using my indicators, and that's really all I needed to know. Notice this breakout above the blue line, and then we continue higher. You can have the same lines on your chart, the same indicators. This TradingView.com interface is free. So once you sign up on, you can get free TradingView account. This is a TradingView.com interface. Go to my site and sign up for the indicators. I'll open the door for you on TradingView.com. I wanted to mention high yield bonds, junk debt, also has hit an all-time high. This is all-time records. Notice again, when the Magnificent Seven were dropping on Thursday, junk debt gapped up. That's why when I saw that underperformance by Magnificent Seven on Thursday, I'm like, I don't know, something is not right here. I think it's a fluke. I think the bigger direction is up. Pretty much everybody is saying that. Everything is saying that. So in my case, we're saying that high yield bonds, small caps, mid caps, mid caps really outperformed, and equal weight ETF. All are moving higher, moved higher on that day, except for Magnificent Seven. So I don't know, it looks like a fluke to me so far. So junk debt moving higher, high yield bonds moving higher. Also very good news, because generally speaking, high yield bonds and stocks correlate highly. Here's the correlation coefficient. And notice that they are indeed mostly spending its time in the positive territory. So high yield bonds and junk debt are doing the same thing, and that's a good thing. That means that we're in agreement. There is no negative divergence of any sort. High yield bonds breaking out to new records. Good news there. So stocks most likely will continue higher. Eventually there will be a pullback. There is no way to know at what level the pullback will be for S&P 500, and we will when or if we get there, we will definitely know about it. But for now, let's keep our positions open on the long side and enjoy the ride. Very briefly, I wanted to touch on the dollar and gold interplay. So up until very recently, I was thinking that dollar is on an uptrend. So notice this upward facing arrows. The only thing that when I started, the doubt started to creep into my mind is this area right here. I'm gonna zoom in on it. Right there. So it is on the 26th of June, 27th of June, 28th of June, and again on the 2nd of July. So notice that the price action for the US dollar came up to this green support resistance line and failed to penetrate above it. And actually then it just completely unraveled. And this unraveling continues to today. So today we closed at the lowest level since February 7th. So support break at the blue line, not yet a full-on bearish signal. However, if we get to this red support resistance line, which is not that far away, that would be a full-on bearish support break. I think that would depend on the USD JPY, Japanese yen, which is finally seems to be turning around in favor of Japanese yen after hitting multi-decade lows. So we will be watching this very carefully, and importantly, why do we care about the dollar direction? As I always like to point out, dollar and gold usually, not always, move in the opposite direction. And I think finally we're seeing that happen. Looks like finally dollar is moving down while gold is moving up. So now we're seeing relatively normal relationship between gold and dollar. Why is that happening? Or rather, why is it even an issue? Because notice this is a currency pair, XAU USD. Well, just like Euro USD is a currency pair. Like you don't trade currencies in the vacuum unless you trade futures. But normally you trade currencies as a pair. You trade it against another currency. So in this case, we're trading gold against US dollar. And so if this bottom part of this equation is getting smaller, weaker, then we're seeing a move up by the gold. So the bottom part of this equation got smaller, top continued higher. And this is exactly what's happening. Dollar just weakened, pretty significantly in the past, 2 to 3 weeks. Gold is indeed taking advantage of this fact and moving higher. And actually, we're very close to all-time highs again. So I think a breakout to new records would be pretty bullish and will continue somewhat higher. At least pretty. I don't know how high, but we could at least estimate. So if we break above this level, at the very least, we will move like that much higher. So if we break out above this new, into new records, most likely we'll next leg up would be somewhere to around 2,600 for gold, which is around 6.5% or $162 up from today's prices, from the all-time high prices. So again, we are trading gold, so for us this is good news. Weaker dollar would be a good news for gold investors. We are indeed gold investors. We're trading gold. I personally have gold miners. For example, I have Royal Gold. I'm holding our Royal Gold, our ticker symbol RGLD, and I bought it. I'm following my own system. I'm not playing around. I'm just, we have a pullback towards the blue line. We buy at the blue line. Boom, it moved higher. So right now, my Royal Gold position is up 11%. I'm still holding it because if gold goes to new records, gold miners will indeed follow. So stay tuned for that. Finally, I wanted to mention the euro. And looks like euro has broken out into a new uptrend. This is a momentous occasion because we haven't seen that experience here since, January. So that was the last time. But notice that this was just a giant back and forth with lots of swings up and down. So hopefully, finally, direction has been found. And I have a feeling it has indeed been found. So let me explain why I think euro will continue higher. This way the indicators curve down. Notice this drop for the indicators, and then now we have a breakout. So what happens is when the indicators come closer to the price action, it becomes easier for the security to change the direction. And if the security, in this case, euro versus US dollar, was kind of downward, was doing bearish sort of swings, all of a sudden the indicators came down towards the price action. We have a breakout. There's a very good chance we'll just keep going higher for euro. So again, implying dollar will drop, will continue dropping against other currencies, and gold and other certain commodities, not all, might continue higher as a result. All right, I thank you for watching all the way to the end. Please stay tuned. I will explain how to get my indicators. If you already have watched this, again, thank you again for watching. Have another great trading week. So go over to MasterChartsTrading.com, click on sign up, and I have 2 products and 1 package. So trading indicators are these lines on the chart. You can have them for TradingView.com. TradingView.com is a free interface. Once you sign up on TradingView.com, free interface, come over to my site, sign up for trading indicators. You can get them for $24.95 per month if you buy a year, or you can do a monthly subscription as well. Newsletter, so I send out daily alerts about various securities we trade. Notice that, for example, this week we have traded all of these various securities, or at least we have made adjustments or looked at them in a particular way. For this week, usually I go into various commodities, ETFs, large cap stocks, speculative stocks, as well as gold related stocks. So we will be looking at various securities today. Very interesting pattern. This one right here, uniQure. It's just all of a sudden came out of nowhere, and a very interesting pattern. So if you're a subscriber, stay tuned. I think the best deal is to get both trading indicators and newsletters. Again, that is $49.95 per month if you buy a yearly subscription. And pretty much all of the people who are with me for any significant amount of time have yearly subscriptions. Of course, you can also get the monthly subscription. $59.95 per month is a great deal. And as always, you will get my daily alerts, my weekly members-only videos, as well as the trading indicators that you can have on your chart. Let me know if you have any questions. Thank you for watching. Have another great trading week. Don't forget to make a comment, like this video, share this video. Thank you for watching. Bye-bye.